April 5, 1933. Franklin Roosevelt signs Executive Order 6102. Every American holding gold is given 25 days to surrender it to the Federal Reserve. Price, $20.67 per ounce. Refusal means a $10,000 fine and up to 10 years in federal prison. The conventional belief is that gold is the ultimate crisis asset. The thing you hold when everything else fails. Here's what the forensic record across 8 decades actually shows. In 5 of the 6 major currency crises since 1900, the people who held strategic debt outperformed the people who held gold. And it wasn't close. Start with what Roosevelt did next. After forcing Americans to surrender gold at $20.67, he signed the Gold Reserve Act of 1934 and revalued gold to $35 per ounce. Overnight, every citizen who obeyed the law lost 41% of their purchasing power. Not to inflation. Not to market forces. To government decree. The people who lost nothing. Americans carrying fixed-rate mortgages on farmland and residential property. Their debt was denominated in dollars. Those dollars were being deliberately devalued. The debt shrank in real terms. The land remained. This is the mechanism nobody explains. Fixed-rate debt denominated in a collapsing currency is mathematically a short position against that currency. You borrowed 1,000 units when each unit bought a loaf of bread. You repay 1,000 units when each unit buys a crumb. The debt destroyed itself. You kept the asset it purchased. This is not theory. This is arithmetic. And one German industrialist understood it before anyone else. His name was Hugo Stinnes, and in 1921, he did the opposite of what everyone around him was doing. While ordinary Germans were converting savings into gold and foreign currency, Stinnes was borrowing marks. Aggressively. He used depreciating currency to acquire real assets. Factories. Mines. Shipping lines. Newspapers. By November 1923, when the mark hit $4.2 trillion to the dollar, his debts had evaporated. His industrial empire was the largest in Europe. Carmen Reinhardt and Kenneth Rogoff document this pattern across 70 countries and 800 years of data in This Time is Different. They identify a specific mechanism they call financial repression. The systematic transfer of wealth from creditors and savers to debtors through inflation held deliberately above interest rates. The United States used this exact mechanism to erase the largest debt in its history. American war debt peaked at 112% of GDP in 1945. Rather than default, the government held interest rates below inflation for over a decade. Treasury bondholders, people who had lent money to the government, lost purchasing power every single year through the 1950s. But American families who borrowed at fixed rates to buy homes watched inflation digest their mortgages while property values climbed. A 4% mortgage taken in 1946 was being repaid by 1955 in dollars worth 35% less. The house was worth 40% more. And gold holders during this period, they had a different problem entirely. Executive Order 6102 wasn't fully repealed until Gerald Ford signed legislation on December 31, 1974. For 41 years, Americans couldn't legally hold monetary gold. The supposed crisis asset was illegal to own during the crisis. And this isn't uniquely American. The United Kingdom restricted private gold transactions through exchange controls from 1947 until 1979. India passed the Gold Control Act of 1968, criminalizing private gold holdings above specified limits. Governments have confiscated or restricted gold during exactly the moments holders needed it most. You cannot confiscate someone's debt. No government has ever seized a mortgage and forced a citizen to owe more. Which brings us to right now, and what one of the world's foremost financial historians is warning. Russell Napier, founder of the Library of Mistakes in Edinburgh and one of the most respected financial historians alive, has argued repeatedly since 2020 that developed economies are entering a new era of financial repression. Sovereign debt across the G7 is at levels not seen since 1945. The political incentive to inflate that debt away rather than impose austerity or default is overwhelming. If Napier is correct, and the historical pattern holds, the winning position is structurally identical to 1946 and 1921. Long-term fixed-rate debt. Real assets purchased with that debt. Not gold in a safe. The people who held gold in every major crisis were holding the right instinct in the wrong instrument. They correctly understood that currency was failing. What they missed is that debt denominated in a failing currency was also failing. And that was the asset. Gold is a store of fear. Debt positioned correctly is a store of arithmetic. The mechanism hasn't changed in 800 years of Reinhardt and Rogoff's data. It didn't change in Weimar. It didn't change in 1945. It won't change next time. History doesn't repeat. But the mechanism does. Subscribe. We don't sell gold here. We read autopsies.